Howdy, Jacob here. Today we're looking at we're going to do a deeper dive on Everi Holdings in the hotels, restaurant, and leisure industry. Just remember everything I say will be of my opinion. I've reviewed their quarterly report, most recent 10K, come up with notes from there. But before that, I want to do an initial analysis of financials to remind everyone about the business. And then just remember everything I say is my opinion. Do what you want with it. Use it or don't use it. I don't really care. Um, I hope you do learn something though. And if there's anything else you want to look at, just let me know. Um, but for now, I'm going to do a high level review of Everi Holdings. Again, hotel, restaurant, leisure industry, a little bit more debt than cash on hand. They supply entertaining game content, gaming machines, and gaming systems and services for land based and iGaming operators, US, Canada, and internationally. Founded in 1998, based out of Vegas. Revenue growth is not very substantial over the last 10 years, just under 600 million to just over 800 million. Pretty cyclical business. We see 2018 a huge decline, 2020 a huge decline, but outside that, pretty solid revenue growth. Gross margin has gone absolutely wild to where they're as high as 80% now, and their operating margin is as high as 20%. That's going to likely be because of a change in their business going from just gaming to gaming plus financial. And so your gross margin is heavily impacted by that. And your operating margin is very bumped, definitely bumped because of it. Return on invested capital still having trouble getting to consistently double digit range, but not terrible the last 3 years. Looks like they do spend a little bit of money on R&D. This is going to be about 6 to 9% of their revenue is going to R&D. So again, taking money away from today to hopefully make more in the future, become more efficient. I don't mind that. Balance sheet has 267 million cash on hand with 6 million short-term debt, just under a billion long-term debt. So a good amount of debt there. And free cash flow production, rolling 12 is fantastic. But even still, a lot more cash from operations. Obviously, CapEx is going up, but much more production of free cash flow, with majority of their money going to acquisitions and share repurchases. So now let's look into some of the notes I took from the quarterly reports 10K. Their free cash flow and share repurchases are highlighted at the beginning of the quarterly reports. Again, those are two things that I think are very important, that a company that is kind of more well established, not in the huge growth phase, those are two things that I think are incredibly important. So good to call them out. Good to know that the business has a similar mindset to myself. Two revenue sources are gaming and fintech. Gaming consists of supplying gaming content, machines, systems for operators. Their fintech consists of solutions that power casino floors, improve operation efficiencies, and satisfy regulatory requirements. Everi owns the machines and gets paid by the daily fixed fee as a percent of winnings. Their gaming equipment sold, game content, and licensing fees. So that's going to be more of their gaming portion. Their fintech portion revenue is transaction fees based on their ATMs and transactions. So again, that's a pretty high margin business right there. You just take a fee off the top. Doesn't take much to have the hardware of an ATM. And so you just get a fee of all the transactions that are done within those casinos using that ATM. 2023, over 2,800 casinos and other gaming properties were served. Their share repurchase program currently represents just under 7% of the current market cap. This is still from May of 2023. A new program will hopefully be placed shortly. So they will likely have to renew their share purchase program, but the amount currently outstanding, 7% of the business, that's still a good amount of shares to be able to be repurchased. You just want to see them update that program soon. Debt obligations are $6 million every year through 2027. That's going to likely be their interest on it, and then $562 million in 2028, $400 million in 2029. So most of their debt is not due for the next 4 or 5 years. Capital allocation is 23% acquisition, 29% debt reduction, 34% share repurchases. So pretty consistent on their allocation of capital. Very impressive. using close to 100%, meaning that their cash likely went up a little bit from 2021 to the end of 23, but still using a good amount of that capital to hopefully do the most advantageous thing for them at that moment in time. Operating income margin for the games portion was 27, 25, and 14% respectively, with revenue year over year of 16% and then minus 2% most recent year. Their operating income margin for fintech is 34, 31, and 31%, so higher than their games portion. Revenue up more, so 22% and 9%. So good to see that the revenue portion coming from the higher margin business is increasing greater than the lower margin business. So that's a huge sign. That's going to mean that you're basically making, off of each dollar, you're making more money. They have no single customer accounting for more than 10% of revenues. Again, just meaning that you're diversified with the income coming in. One client leaving you isn't going to really harm you very much. So my new assumptions really hold that the gambling business, the casino business, is kind of looked at as kind of what I would call a sin stock. So this could be maybe tobacco. This could be cemeteries. This could be gambling, drinking, all the things that are not necessarily improving society, one would say. I think those companies have less demand for them, and unless they're extraordinarily consistent, some people just won't buy those companies. And so I think that deserves a lesser of a premium. In fact, in the opposite of a premium. And so I think with 5% revenue growth, although that's pretty close to in line with the market average, and although I think at the end of 7 years, their debt is going to be reduced pretty heavily as they'll hopefully spend 30% or so capital allocation to debt reduction, I think a 12p to me makes the most sense and is the most appropriate. And with my slightly declined margin of free cash flow, I reduced their share repurchase program or share repurchase amount slightly. So with these new assumptions, we're saying it needs to fall 34%. I mean, I do think it's an interesting business. I think that they do have a lot of competition. I don't think it's that hard to be able to compete with them. I think relationships are going to be incredibly important. And when I think of buying a company, I don't want it to be entirely based on the relationship. I want it to be a company that no one else can use because it's the better product or this, that, the other. Again, they are spending a little bit, 6-9% of the revenue in R&D. So that's hopefully trying to make better machines, better products for their customers. But that's not guaranteeing anything. And so initially right now, I'd say interesting business. If it goes down to this price, I'll probably look at their competitors, see if they do have some sort of competitive advantage, and see if this price point does actually make sense to me. For now, I hope you enjoy this video and have a great day. Thank you.